Raphael Bostic joins me now. He's the president and CEO of the Federal Reserve Bank of Atlanta. Mr. Bostic, thank you for being with us. Last week, Bloomberg reported that you said there could be a case for moving on the lower end of the Fed's possible interest rate hikes if the CPI report showed prices cooling. So given this report, what's your view about what the Fed should do?
Well, I think this report was really welcome news, and it really suggests that inflation is moderating, and it gives me some comfort that we might be able to move more slowly now that we're in restrictive territory. And so if the information that I get from business leaders and others is consistent with that, and it's the first signals we're getting is that they are, I'll be comfortable moving at a slower rate, even 25 basis points, relative to what you saw us do through 2023 or 2022.
One other signal, I wonder if you thought this was a positive signal in the same respect, is that in the December jobs report, there was a sign that wages were going up, but not too fast. Was that also another welcome sign in terms of what you're looking for to see that the economy is cooling at the right amount?
Yes, absolutely. You know, wages is one of those components that businesses have to pay attention to. And if wages are higher, the end price in the marketplace will be higher. So the data that we have a tool that we call the Atlanta Fed Wage Tracker, and it's shown that wage increases peaked in the summer, and they're starting to come down. That's also very positive.
Now, another thing that was attributed to you, and you'll correct me if I'm wrong, is that you thought that interest rates should be around 5%, maybe even go higher, and they should stay there for a while. Why is that your view? And explain how that would work with respect to unemployment and jobs.
Well, the key thing is that we need to get inflation down to our 2% target. That's the most important thing. And what we've tried in the past, when the Federal Reserve has started to reduce inflation by increasing wages, but then reverses that quickly, we start to see spikes in inflation. And those spikes in inflation really cause American consumers to be very uncertain about what prices are going to be. That's exactly the opposite of what we want. So we need to have a policy strategy where we get inflation under control, it doesn't move back up, and then consumers can then not have to worry about that. You know, Alan Greenspan said a long time ago that that inflation has been taken care of when people don't think about it anymore. We've got to make sure our policies accomplish that.
Now, if the policies accomplish that, of course, the worry is that there is problems on the job front, that the Fed keeps rates so high that it starts to increase unemployment. And I saw a figure, and I wonder what you think of it. The Fed's target, I believe, for unemployment is 4.6%. But the figure I saw said that in the last 70 years, when unemployment went up by 1%, that it also then went up at least another percent in addition to that. So I guess what I'm wondering is, if the Fed is expecting unemployment to go up, but not that much, is that a realistic expectation that once unemployment starts going up, that it's going to keep going up?
I actually think that the past is not a good predictor of the experience we're going to have. You know, the pandemic has been unprecedented in so many ways, and the situation we're in today is quite unlike what we typically see in a high inflationary environment. The economy is still producing more than 200,000 jobs a month. And that means there's a lot of momentum and a lot of energy in the economy that will be absorbing the restrictive effect of our policies. My hope and my baseline outlook is that we're not going to see significant job dislocation. And as you reported, most of my colleagues are in the same place. So my hope is that we can start to see the economy slow down, get inflation under control, but still at the same time not see the massive dislocations that often are associated with recessionary episodes.
Now, you say that you don't think you'll see that, and yet we report consistently on business leaders and economists who say that they're expecting a recession in this year. What's your feeling on that question?
Well, I talk to business leaders just like you do, and I ask them, not do they expect a recession, but I ask them instead, do they expect that their business is going to be significantly worse in the next 12 months? And almost to a business, they tell me no. The demand is strong. Their consumers are in good position, and they're not looking to lay people off. Rather, they're struggling to hire more people. And if the constraint that we have right now is that we can't get enough supply produced, that's a very different situation. And it suggests that if there's going to be a slowdown, that the likelihood that it becomes a recession, and a deep one, is far lower.
And finally, last question for you, Mr. Bostic. You quoted Alan Greenspan that inflation's under control when people aren't talking about it. But is there an actual numerical signal for you that will give you a sense? I know 2% is the inflation target for the Fed, but is there something before you get to 2% that you're looking at to give you a sense that the arrow is pointed in the right direction and you're not worried about those spikes in inflation that you mentioned earlier?
Well, yeah. So one of the things I definitely look at is inflation expectations and what consumers are feeling. The psychology of the marketplace is so important. And if I get to a place and I start to see clear signs that both business leaders and consumers are feeling very comfortable and confident that we're back in an environment of price stability, that will make me very comfortable with how the economy is evolving, and we will be able to get our policies back to a more normal stance.
All right, Raphael Bostic, we'll hope to talk to you again in that moment of comfort. We're grateful you're here now, though. Thanks very much.
I can't wait for it to come.